What if the biggest financial risks in 2026 aren't the market crashes you see on the news, but quiet mistakes most people never even notice? Mistakes that don't feel dangerous at first. Mistakes that look normal. Mistakes that slowly drain your money, your opportunity, and your peace of mind. Things like overpaying for hyped AI stocks, trusting the wrong smart trading tools, or ignoring rules that quietly change behind the scenes. By the end of this video, you'll know 7 hidden financial pitfalls coming in 2026 and exactly how to protect yourself from them. This is Future Finance Lab. I explain the future of money, AI-driven markets, and investing, all in simple language. And this video matters because 2026 looks fine on the surface. Markets are up, AI is everywhere. Confidence is high. But that's usually when the most people walk right into traps. Let's start with the first one. Pitfall number 1. AI stock overconcentration. A lot of people think they diversify because they own an index fund or several different tech stocks, but here's the hidden risk. Most of the recent market gains are coming from just a handful of AI and tech giants. That means your portfolio might look diversified on paper, but in reality, it's secretly depending on just 5 to 10 companies. Think of it like this. You believe you have a team of 50 players, but only 5 are actually on the field. If one of them gets injured, the whole team struggles. This isn't about avoiding AI. It's about avoiding blind concentration. To protect yourself, check how much of your portfolio is actually sitting in its top 10 holdings. Then, set a personal rule for how much you're willing to depend on any single company or sector. It's a simple check that can save you a lot of trouble. Now for pitfall number 2. Sticky inflation and the rate cut fantasy. Many investors are planning their finances as if interest rates must fall quickly and everything will become easy again. Cheaper loans, faster growth, stocks going straight up. It's a nice thought, but inflation doesn't always cooperate. If inflation stays sticky, meaning it remains stubbornly high, central banks can't cut rates as much as people hope. That means borrowing stays expensive. Weak companies feel the pressure, and growth slows down quietly, not dramatically. The real danger here is building your entire financial plan on a perfect, best-case scenario. The safer approach is simple. Ask yourself one question. Would my plan still work if rates stay higher for longer? If the answer is no, your plan needs an adjustment. Prepare for reality, not just for your hopes. Let's move to pitfall number 3, rising corporate defaults. A default simply means a company can't pay back its debt. When interest rates stay high, companies with weak balance sheets and a lot of debt are the first to crack. This often hits high-yield bonds, speculative stocks, and any business carrying heavy loans. The trap for beginners is chasing investment yields that look too good to be true. High returns often come with high hidden risk. To protect yourself, be cautious with unusually high yields, and take a quick look at a company's debt before you invest in it. A little bit of homework can help you avoid a lot of headaches. Next up, pitfall number 4, recession probability and job risk. You might see experts say there are only a 30% chance of recession and think that as low. But that number is still serious for normal people. Why? Because your income doesn't average out like the stock market does. You either have a job or you don't. The hidden mistake here is over-investing while undersaving your emergency cash, just because the markets are up. Layoffs don't announce themselves in advance. And with automation and AI constantly changing the job market, job stability isn't what it used to be. The protection is boring, but it's powerful. Build an emergency fund of 3 to 6 months of living expenses before you take on heavy investment risk. Cash doesn't feel exciting, but it buys you time, options, and most importantly, peace of mind when you need it most. Pitfall number 5, the 2026 scam upgrade, trading gurus. Scams are evolving. They don't look cheap anymore. They look professional. They use clean websites, technical language, and the word AI everywhere you look. The common promises are the same as always. Daily guaranteed returns, secret algorithms, and a lot of pressure to act fast before the opportunity is gone. Here's a rule that never expires. If someone guarantees returns on an investment, it's a no. It's that simple. No real system can remove risk, and no legitimate investment needs that kind of urgency to work. Stick to regulated platforms. Avoid anyone who promises secrecy, and never, ever confuse complexity with intelligence. On to pitfall number 6, new tax and reporting rules. Now, this isn't legal advice, but here's the high-level reality you need to know. Governments are getting much better at tracking digital transactions and investment activity. The hidden danger is assuming your small trades or that little bit of side income are invisible. They're not. And tax surprises usually arrive later in the form of letters, penalties, and a whole lot of stress. Protection here is simple discipline. Track every trade you make. Keep basic records. Use reliable software, or if you're unsure about anything, speak to a qualified professional. A little bit of clarity now prevents major problems later. And finally, pitfall number 7, policy drama and panic selling. Every single year brings shutdown threats, credit rating scares, and dramatic headlines that make it feel like the sky is falling. These moments spike volatility in the markets and trigger emotional decisions. The hidden mistake is selling everything in a panic because the headlines feel urgent and scary. But here's the thing, markets have survived wars, crises, and recessions. They always have, but they punish panic. The solution is to have a written plan before the drama starts. Know your time horizon, know your risk tolerance, and decide in advance the conditions under which you will not sell. Expect 1 or 2 scary news cycles every year. They are normal. Your reaction to them doesn't have to be. So let's recap the 7 pitfalls. I concentration risk, sticky inflation, corporate defaults, job instability, AI-powered scams, tax surprises, and policy panic. Most people will fall into at least one of these traps in 2026. Now you don't have to. If this video saved you from a future mistake, hit that like button. And subscribe to Future Finance Lab for clear, calm breakdowns of the future of money. Because in the next decade, the biggest advantage won't be speed or hype, it will be understanding. Thanks for watching.